How do you do, ladies and gentlemen? This week I'm going to have a look at a few basics concerning the world of investments. This is in response to requests for me to do just this little thing. Investing, of course, is a precarious enterprise. For example, how did you know that investing in Amazon in the late 90s was going to turn every £1,000 into more than 2 million? In one sense, it's easy, and I'll suggest the easiest way. But as with all of these questions, you have to start with some sort of ground rules. Even before we get to some rules, let me state what is hopefully obvious. This is a 10-minute blog, not a 500-page textbook. That means I scratch the surface. If there are particular points in this brief encounter that you would like me to explore further, please do let me know. Rule 1 is to arrange your affairs so you have money available to work for you. But this does come with a caveat. You don't want to put your way of life at risk. You must never get into a situation where you could be ruined. You need to make sure the books balance. Then you can lose some money, but not lose sleep. The second thing to do is to make sure you use investment's number one reliable feature, compounding. This means when you start your investing career, and the earlier you do that, the more wealth you will acquire, you should look to invest in the basic industries that will go on producing money and raising their dividends. You should be investing in stocks such as Coca-Cola, Johnson & Johnson, Glaxo, and so on. Then forget about them and let them build over the decades. That's one leg of your plan. In the 70s, we had a major crash, followed by a grounding bout of high inflation. However, I soon learned that crashes were an investor's dream. Welcome to the second leg of your investment strategy. The young investor has to learn that a good wham-bang crash can set you up. You just have to see it coming. There are signs. I'll go into that specifically in next week's blog because we are possibly approaching such a situation right now, but I want to analyze how we work out what is really going on. Let's analyze the pros and cons of a market crash. The downside of such a situation is that those who've invested in pension plans are going to take a hefty hit. If you're going to buy shares, don't invest in a pension scheme. Every month they have money coming in, and so they have to park it somewhere. It goes into stocks. Pension funds usually can't just cash out all their positions because they think a crash is coming. So the obvious problem is that your pension money goes down with the crash. Don't get caught out that way. Steer clear of pension funds. Now, think like a sensible woman. There's a market crash. Prices may halve. What would the average lady do when walking down the high street? She looks in the shop windows, fancies perhaps a particular coat or a skirt, but doesn't like the price. One day the skirt is on sale at half price. What does she do? She nips in Sharpishes and buys it. Okay. Now let's return to the stock market. You like Company A and your searches show it to be good value at £100. The dividend isn't too bad either at 3%. You think there is likely to be a market crash in the offing. The average guy will, once the market has crashed, sell everything. You, however, now see Company A trading for 50 quid. If it was a good deal at £100, then it must be a steal at £50. And, of course, the dividend is now a much more interesting 6%. Surely it's time to buy. The high street has sales. The stock market has crashes. They are both signals that it's time to buy. Most people do the opposite. They wait until the bull market has worked up a head of steam and then decide to buy. Remember, the ideal rule is buy low and sell high. Most personal investors, for some strange reason, do the opposite. The third leg of our investment advice is to invest in what might be called the flavour of the decade. When I started investing, rather a long time ago, I decided that the in thing was to sink funds into real estate. This asset had everything going for it. Mortgages were at last becoming mainstream, which meant people could afford to pay a lot more for houses than when they had to stump up either the whole cost price or a large proportion of that. That meant house prices were certain to rise with the ability to pay. And buying a house was also the socially in thing to do. So, I invested in real estate. The third leg of your scheme is to follow trends, as mentioned at the beginning. In the 60s and early 70s, that trend was clearly housing. In the early 80s, it was housing again and Japanese unit trusts. In the early 90s, it was housing again. The crash brought some amazing buys in the UK market. I was buying properties for a rental that had a PE ratio of 1. That's insane value, but the idiot banks wouldn't lend on purchases. That's when I and my friend Jerry started Buy to Let, and when I wrote my first book on the subject, which no publisher would touch. So I published it myself in 1993. From 1991 to 2004, if you chose the right part of the UK, you could make money hand over fist in real estate. You had another market crash in the year 2000, so the obvious place to be in 2001 was the stock market. And what was the in thing? Going digital. The whole of the 90s was about the beginning of the digital age. I was busy with both the internet and real estate all through the 90s, but once we had the crash, I knew it was time to hit digital stocks with a vengeance. The crash of 2008 was easy to spot. I exhorted my readers to pretend they were sitting on the top of the housing price chart in the USA. What I said was, "Don't you feel seriously giddy up here?" How many people took any notice is another matter. But I got out of stocks. After the crash, I should have bought back in, but for some reason I didn't, which was a bit of a mistake. But I was busy with internet matters, and it wasn't until 2015 that I realized that money was going digital, and I started following Bitcoin. I advised my readers to buy when the price reached $282. A couple of years later, I hassled my entire family to start buying quickly before it was too late. My alert went out as Bitcoin hit $800. And, foolishly, in retrospect, I stopped buying when the price hit $1,900. So, now you are probably all saying, what's the in thing to buy right now? Well, find an expert in AI, biotech, and altcoins. They're the 3 important businesses these days, and all will deliver. You have to get the right instruments, of course, and you need guidance for that, but I am loath to suggest who to follow. All I will say is that if you email me, I will tell you who I follow, but I won't say any more than that. I'm also investing in SPACs, that is, Special Purpose Acquisition Companies. It's the new way to take a company public. It's early days so far, so I can't point to much in the way of success just yet. But I'm confident this new market will produce the goods. Okay, next week I'll talk about how I think you should play the coming market crash that everyone is warning about. Until then, please do like these blogs and see you next week.